You've taken examples from Canada, Switzerland, and a few other countries. You know, I'd be remiss not to address the issue of spillovers. We are an institution that is concerned by 188 countries. They are the members. And we are doing as much research as we can to identify the spillovers from monetary policies and macroprudential tools used as you have described them. We have seen an episode of strong spillovers between, say, May 2013 and August 2013. I know it's not directly in your mandate to worry about the spillovers. It's in mine. And we compare our notes and on a friendly basis. But how do you perceive them? How do you integrate them in your way of thinking? And are you attentive as well to what we are working on, which is the study of the spillbacks from the spillover? And for those who are not so much in tune with our spill business, the spillovers, I think, is widely understood as the consequences outside of domestic base of decisions made in terms of monetary policy in that domestic base. The spillbacks is the consequences of the spillovers as they bounce back to the domestic markets where the decisions were originally made. And I'm sure that you pay attention to it.
So we certainly do pay attention to spillovers. Although the Fed, and this is true of most central banks, the mandates that we're given by Congress or the relevant legislatures tend to focus on domestic goals. Yeah. We certainly strive to avoid harm in generating spillovers when we use monetary policy. And, of course, we are very much affected by the global environment, and so the spillbacks to which you refer are central in our analysis of our own economy and what the impact of our policies would be. I mean, I think if you look at U.S. monetary policy generally, given, of course, there are spillovers. I mean, in global financial markets where capital flows are as large as they are in the global economy today, and financial markets are so interconnected, of course there are spillovers, and there's no denying that. But I think, when you've seen significant impacts on, say, emerging market economies from capital flows, I think most studies, ours and I think those of other researchers, would suggest that there are a multiplicity of factors that are causing it, of which movements in global interest rates would be only one. So, for example, when we instituted QE2, which generated, in that period after that, there were capital inflows into many emerging markets. There were other factors also. Stronger growth in the emerging markets, I think, was an important factor. And shifts in risk attitudes among investors globally that are not necessarily driven by monetary policy. But I guess the other point I would make is that the studies that we have done, I believe this would be consistent with the IMF's analysis, would suggest that when the United States, as important as we are in the global economy, when we adopt policies in pursuit of price stability and full employment, given our importance as a purchaser of goods from other countries, generally these are not big or thy neighbor policies. We're not mainly affecting foreign countries by pushing down, say, with expansionary policy, our exchange rate to their detriment. When our economy expands, we buy more. And on balance, I think the spillovers are not negative. They're typically positive. But you did refer specifically to the episode a year ago. And, of course, we did see, before there had been any real change in monetary policy, but a shift in communications about future monetary policy, a very pronounced jump in interest rates. And for some countries, and I think they were typically emerging markets with greater vulnerabilities, there were pronounced capital outflows that put pressure on currencies, caused those countries to tighten monetary policy. And obviously those were disruptive.
Just to give you an example, because Michelle Bachelet was here exactly where you are yesterday, and she was reminding me that at that time, the currency in Chile went up by 30%. Now, it subsequently went down a bit, but it had immediate and strong effects on those countries. New Zealand is another point in case of that.
I think there, in part, what was happening is that traders had built up positions that were premised on unrealistic expectations about interest rate paths and about the appropriate level of volatility. And it wasn't just a shift in monetary policy, but a rapid unwinding of carry trade and leverage positions that had built up that caused that damage. I've pledged often and will continue, we will try to conduct our monetary policy to communicate about it and to conduct it in a manner that is understandable to financial markets, to avoid the kinds of surprises that could cause jumps in interest rates that cause such capital flows. To some extent, I think such spillovers are really unavoidable in a situation that with global capital markets. I don't know if you would share this assessment, but my own assessment is that most emerging markets do have much stronger financial systems than they had at the time of the crisis that Michelle had to intervene.
And it's because they went through the crisis with the support of Michel and his team that they felt a lot stronger afterwards.
And
for sure.
All the things that were put in place, that the kinds of shocks that we may see or spillovers as hopefully the global economy recovers and we're in a position to be able to tighten monetary policy. I wouldn't assume that this is going to go badly, and I can just say that we will do everything on our side to make sure that it goes smoothly.
Well, thank you so much for this commitment to it. Certainly, they are representatives of the emerging market economies here in the room, and I'm sure that they are particularly interested in your views as to how you can best communicate and they can best anticipate so as to limit the volatility risk that arises from that. I will ask you a final question before we wrap up, because I know that we are pressed for time. Michel referred to Napoleon Bonaparte, who said that the central bank should be independent but not too much. With that enlarged responsibility in a way? Well, purposely I changed a little bit, Mr. Monetary policy, macroprudential tools to be used for financial stability, your dual mandate in a way of both employment and growth. Are you independent?
Well, I think we are independent, and appropriately so, in the conduct of monetary policy. Congress has established the goals that we're to pursue, and I think this is true in most countries, that there's not goal independence, right. But there is independence about how to carry out monetary policy.
You've been a fantastic
Thank you so much.
Speaker. You've been a terrific partner in this venture, and I look forward to continuing working for you.
As I do too.
Thank you so much.